While the world focused on price charts and headlines, the real event happened inside sealed vaults and clearing rooms. On screens, silver surged, paper claims multiplied, arbitrage tightened, margin calls flashed and vanished. Liquidity appeared abundant because it was promised, not delivered. In physical space, something else occurred. Bars were recounted, schedules slipped, substitution clauses were invoked, delivery windows widened. The distance between paper and metal stopped being theoretical. This was not a forecast. It was a sequence. A large silver fund did not fail because price moved against it. It failed because the system that allowed paper claims to exceed physical metal reached a mechanical limit. When withdrawals converged with settlement dates, contractual language replaced certainty. Force majeure entered the conversation quietly, then formally. What follows is not a story of speculation. It is an inventory of stress, how liquidity thins, how arbitrage reverses, how margin accelerates losses, and how vaults, finite by design, become the final arbiter. The escalation was orderly, and it wasn't. What visibly broke was nothing dramatic. No crash banner, no exchange halt, no emergency press conference. On screens, silver prices accelerated upward in orderly fashion. Volume expanded, liquidity appeared deep, commentators described momentum, funds reported inflows. The public saw a market functioning normally, volatile but healthy. What actually happened was quieter. Behind the screen, settlement behavior changed. Positions that would normally close began to roll. Delivery notices slowed. Open interest remained high even as physical availability tightened. The market did not freeze. It stretched. The noise was price. The signal was behavior. Paper claims multiplied faster than metal moved, and almost no one noticed. This failure began mechanically. Step 1. Rising prices increased arbitrage incentives. Futures, swaps, and fund units offered exposure without requiring immediate physical delivery. Market participants chose paper efficiency over physical constraint. Step 2. Liquidity appeared to deepen. More contracts traded. Tighter spreads suggested balance. In reality, this was synthetic liquidity. Claims referencing metal, not metal itself. Step 3. Margin pressure followed price. As notional exposure grew, margin requirements increased. To meet them, participants added capital or rolled positions forward instead of settling. Physical demand was deferred. Step 4. Institutional exposure concentrated. Clearing members, brokers, and large funds accumulated counterparty risk. Everyone assumed exit liquidity would remain available. The analogy is a queue that keeps growing because no one reaches the door. As long as people believe the line is moving, no one leaves. But the door hasn't changed size. This was not misbehavior. It was rational response under existing incentives. The first escalation was subtle, margin adjustments. Higher prices meant higher collateral demands. This removed liquidity quietly, siphoning capital from secondary markets. Next came soft constraints. Position limits were discussed. Volatility controls tightened. None of it stopped trading. It redirected it. Then historical rhymes emerged. In 1980, rule changes halted silver momentum after leverage overwhelmed deliverability. In 2008, liquidity vanished not because assets failed, but because trust did. In 2022, the LME halted nickel trading when paper exposure exceeded physical tolerance. Each precedent shared a pattern. The rules changed only after stress became undeniable. At this stage, stress was present, but still deniable. Away from the screen, signals accumulated. Dealer premiums widened modestly. Not enough to alarm, enough to notice. Delivery timelines extended, not canceled, adjusted. Inventory classifications shifted. Eligible metal remained visible. Registered metal thinned. The distinction mattered, but few tracked it. Industrial buyers reported longer lead times. No shortage declared, just friction. These were not headlines. They were whispers. The market still looked liquid. But liquidity was already being rationed, quietly, mechanically, and without announcement. And once that process begins, it does not reverse on sentiment alone. What visibly broke was nothing the public could see. On screens, silver continued trading, prices held, volume persisted, contracts cleared. From the outside, the system appeared intact. Inside the vaults, movement slowed. Bars that normally rotated between owners remained stationary. Transfer requests were deferred. Allocation schedules stretched from days into weeks, not canceled, reordered. The public saw a market. The system experienced a constraint. This was not a run. There was no panic withdrawal. There was prioritization. Existing obligations were quietly placed ahead of new ones. Redemption language was reread. Bar lists were reconciled against reality. The vaults did not empty. They became selective. And selectivity is the first visible form of scarcity. The failure here was mechanical, not emotional. Funds, futures, and swaps changed hands without touching metal. Liquidity on screen remained fluid. Step 2. Physical inventories revealed rigidity. Bars cannot be split, accelerated, or conjured. Each unit has weight, serial numbers, and location. Rehypothecation works only until delivery is requested. Step 3. Arbitrage broke down. As delivery demand increased, the incentive shifted. Participants preferred retaining physical metal over lending it into paper structures. The spread between ownership and access widened. Step 4. Institutional exposure concentrated. Custodians bound by specific bar lists faced fulfillment limits. Funds offering redemption at spot prices assumed convertibility that no longer functioned smoothly. The analogy is a bottleneck. Traffic flows freely on the highway until it reaches a narrowed passage. The speed limit on the road is irrelevant once lanes disappear. Inventory did not vanish. Mobility did. The first response was administrative. Delivery windows were extended. Language was adjusted. Flexibility was emphasized. Next came indirect pressure. Margin requirements rose again, discouraging additional physical requests by increasing the cost of holding positions through settlement. Historical parallels are instructive. In 1980, silver delivery stress forced rule changes once leverage overwhelmed available metal. In 2008, assets existed, but liquidity froze because access did. In 2022, the LME halted nickel trading when physical supply could not anchor paper exposure. Each case followed the same progression: constraint, discretion, intervention. At this stage, intervention remained optional, but the path was narrowing. Signals accumulated away from headlines. Dealer premiums widened more decisively, not uniformly, selectively, certain forms, certain sizes. Delivery delays became common knowledge within the industry, not publicized, acknowledged. Inventory classifications shifted again. Eligible metal remained listed. Registered metal, available for immediate delivery, declined. The difference was technical. The implication was structural. Industrial buyers adjusted procurement strategies. Lead times extended. Substitutes were discussed. Stockpiles were reassessed. None of this moved the screen price immediately. But the doc was telling a different story. And once access to physical metal narrows, price becomes secondary to possession. The system had not failed. It had revealed its limits. What visibly broke was the relationship between price and delivery. On screens, silver continued to trade in tight increments. Charts suggested continuity. Liquidity appeared present. Settlement dates rolled forward without incident. In physical space, conversion failed. Requests that crossed from paper into metal no longer resolved cleanly. Cash alternatives were suggested. Delays became normalized. What had been an option, financial settlement instead of delivery, quietly became an expectation. The public saw a price. Institutions confronted a choice. Paper claims still cleared. Physical metal did not. The divergence was now operational. This failure unfolded in a precise sequence. Step 1. Arbitrage inverted. Under normal conditions, price differences between futures and physical delivery invite convergence. Here, immediate physical access carried a premium. Arbitrage no longer compressed spreads. It exposed them. Step 2. Liquidity was selectively removed. Participants willing to part with physical metal withdrew it from lending structures. Paper markets remained liquid only because delivery was avoided. Step 3. Margin pressure accelerated the split. Rising prices increased collateral requirements. To meet them, holders sold paper exposure rather than risk delivery. This pushed more volume onto the screen and less toward the dock. Step 4. Institutional exposure became explicit. Market makers found themselves bridging two incompatible systems: infinite claims and finite inventory. Clearinghouses faced settlement risk not from default, but from delay. The analogy is a vacuum. Air moves freely until pressure drops below a threshold, then flow reverses violently to fill the void. The vacuum here was physical availability. Stress responses followed familiar patterns. Margin requirements rose again. This reduced participation. Liquidity thinned. Position limits were discussed more openly. Not imposed yet, prepared. Rule flexibility expanded. Settlement language emphasized commercially reasonable efforts. The historical rhymes were unmistakable. In 1980, silver futures were restructured once physical delivery threatened the system. In 2008, markets remained open while interbank lending froze beneath them. In 2022, the LME halted nickel not because prices were wrong, but because delivery could not anchor them. Each episode marked the same realization: paper stability depends on physical compliance. That compliance was now conditional. Signals hardened. Dealer premiums detached from futures prices. Spot quotes lost relevance for immediate delivery. Delivery timelines extended again. Weeks replaced days. Then estimates replaced commitments. Inventory reports showed further erosion of registered metal. Eligible stocks remained, but conversion slowed. Availability became a negotiation. Industrial demand intensified quietly. Manufacturers secured supply ahead of need. The intent was not speculation, it was continuity. The screen continued to quote prices. The dock continued to restrict access. And between the two, confidence thinned. At this stage, failure was no longer hypothetical. It was mechanically implied by the structure itself. What visibly broke was order. On screens, volatility increased. Not a collapse, a disorder. Bid-ask spreads widened. Liquidity thinned at specific moments, then returned. To the public, this looked like stress, manageable, temporary. Inside institutions, it was different. Credit committees met off-cycle. Clearing members reassessed counterparty exposure. Internal risk models were updated in real time, then updated again. The concern was not price direction. It was settlement integrity. Trades still cleared. Trust did not. The system continued operating, but only because participants reduced exposure simultaneously. That coordination was unspoken. It was inferred. This is how panic looks in institutional space. Quiet, procedural, and contagious. The cascade followed a strict sequence. Step 1, margin requirements increased sharply. As volatility rose, exchanges demanded more collateral. This was automatic, rule-based. Step 2, liquidity was withdrawn to meet margin. Funds sold what they could, not what they preferred. Paper positions were reduced first. Physical requests were postponed. Step 3, arbitrage collapsed under capital strain. Opportunities existed, but balance sheets could not support them. Arbitrage requires excess liquidity. That liquidity was gone. Step 4, institutional exposure surfaced. Clearinghouses faced concentrated risk from fewer, larger participants. Brokers absorbed client failures. Banks providing credit lines reassessed availability. The analogy is a margin call moving through a system like a queue that suddenly reverses direction. Everyone is trying to exit through the same narrow opening at the same time. The system did not break because participants panicked. Participants panicked because the system's design removed alternatives. The escalation accelerated. Margin hikes became frequent. This increased stress exponentially, not linearly. Trading halts were discussed as contingencies, not yet triggered. Prepared. Rule changes entered formal review. Settlement flexibility, position limits, emergency authority. The historical rhymes were explicit. In 2008, liquidity disappeared not because assets were worthless, but because margin calls forced indiscriminate selling. In 2022, the LME halted nickel when margin cascades threatened member solvency. In 1980, silver trading rules changed once leverage overwhelmed delivery capacity. Each case followed margin. Margin is not a warning. It is a mechanism of enforcement, and enforcement was tightening. Outside institutions, signals turned unmistakable. Dealer premiums surged unevenly. Some products vanished entirely. Delivery delays were no longer framed as temporary. They became open-ended. Inventory data showed registered metal approaching functional minimums. Eligible stocks existed, but conversion slowed to a crawl. Industrial buyers escalated procurement urgency. Reported indications suggest forward contracts replaced spot sourcing. Production schedules adjusted. The screen continued to show a price, but institutions stopped treating that price as authoritative. When margin dominates behavior, price becomes secondary to survival. At this stage, the system was no longer absorbing stress. It was transmitting it. What visibly broke was consistency. On the screen, markets remained open. Prices continued to print. Contracts still existed. To the public, nothing had stopped. Underneath, the rules began to move. Settlement language shifted from certainty to discretion. Delivery obligations were reinterpreted. Optionality expanded for institutions and narrowed for claim holders. What had once been automatic became conditional. The public saw continuity. Participants encountered caveats. This was not announced as an emergency. It was framed as prudence. But prudence is what systems adopt when compliance becomes uncertain. The logic here was linear. Step 1, margin stress made delivery risk visible. Institutions realized that enforcing strict physical settlement would accelerate failures elsewhere. Step 2, liquidity was preserved by altering obligations. Cash settlement options were emphasized, timelines became flexible, paper claims remained valid as long as they stayed paper. Step 3, arbitrage incentives disappeared. When rules can change mid-process, price differentials lose meaning. Arbitrage depends on enforceable closure. That closure was no longer guaranteed. Step 4, institutional exposure was legally managed rather than operationally resolved. Force majeure language entered internal risk assessments. Not invoked yet, modeled. The analogy is a bottleneck where operators begin rerouting traffic through side roads. Not because the road is closed, but because keeping it open would cause collapse elsewhere. The system chose discretion over precision. The escalation followed precedent. First came rule reinterpretation, quiet, technical, defensible. Next came contingency planning for halts, prepared, not executed. Then came explicit reference points. In 1980, silver margin rules were altered to stop delivery pressure. In 2008, contractual obligations were honored selectively as liquidity froze. In 2022, the LME rewrote trades retroactively to prevent member default. Each episode shared a trait. Rules changed to protect the system, not the signal. Force majeure risk is not declared early. It is prepared silently, and preparation alone changes behavior. Signals confirm the shift. Dealer premiums spiked again, but inconsistently. Price discovery fractured. Delivery commitments were replaced with best effort language. Dates softened into ranges. Stability here did not mean recovery. It meant immobility. Industrial demand showed signs of preemption. Reported indications suggest buyers secured metal regardless of quoted price, prioritizing certainty over cost. The screen still showed liquidity, but the dock was now governed by exceptions. When rules become flexible, confidence becomes selective, and selectivity, once introduced, does not retreat. At this point, the system had made its choice. Compliance would be negotiated, failure would be delayed. What visibly broke was resolution. On the screen, prices stabilized, volatility compressed. To an outside observer, the worst appeared to have passed. Markets had absorbed the shock. The narrative shifted toward normalization. At the dock, the opposite occurred. Physical metal continued to leave accessible circulation, not in a rush, methodically. Bars moved from exchange, linked inventories into private custody, long-term contracts, and strategic reserves. Once moved, they did not return. The public saw calm. The system experienced depletion. This was not a run, it was a drain, and drains do not announce themselves until pressure is gone. The final mechanism was unavoidable. Step 1, rule flexibility altered incentives. When delivery is uncertain, possession becomes paramount. Participants who could secure physical metal did so. Step 2, liquidity vacuum formed. As metal exited accessible inventories, remaining supply became functionally illiquid. Paper markets continued to trade against a shrinking physical base. Step 3, margin pressure lost relevance. With fewer participants willing to engage in delivery-linked arbitrage, margin no longer balanced the system. It only enforced exit. Step 4, default risk surfaced explicitly, not through immediate failure, but through cumulative delay. Obligations extended, substitutions offered. Eventually, non-performance became mathematically implied. The analogy is a vacuum draining a reservoir. The surface looks unchanged until the intake begins drawing air. By the time that happens, recovery is no longer possible. The final escalation required no new actions. Margin had already done its work. Halts were no longer necessary. Rule changes were in place. What remained was exposure reconciliation. Cross-default clauses were reviewed. Insurance coverage was questioned. Counterparties reassessed collateral quality across unrelated markets. The historical pattern completed itself. In 1980, the silver market did not default outright, but it was structurally reset. In 2008, failures emerged months after liquidity froze. In 2022, nickel's damage persisted long after trading resumed. Default risk does not require announcement. It requires time, and time was now working against the paper system. Signals confirmed exhaustion. Dealer inventories thinned permanently. Premiums reflected scarcity, not speculation. Delivery delays hardened into exclusions. Some forms simply could not be sourced. Registered inventory reached levels that implied functional non-deliverability. Eligible metal existed on paper. Access did not. Industrial users adapted structurally. Reported indications suggest redesign, substitution, and long-term contracting replaced spot reliance. The screen continued to print prices, but the physical system had already moved on. At this stage, failure was no longer a scenario. It was a condition. What visibly broke was settlement confidence. On the screen, contracts still existed. Prices still printed. Officially, nothing had failed. To the public, the market appeared strained but operational. Behind the scenes, deliveries were missed, not declared as defaults, framed as delays, rolled forward, substituted. What had begun as scheduling friction hardened into non-performance. The difference was not semantic. It was legal. The public saw continuity. Institutions saw exposure crystallize. This was the moment when timing risk became default risk, and default risk does not remain contained. The mechanism here was cumulative and precise. Step 1, repeated delivery delays altered probability. Each missed window reduced confidence that future windows would resolve. What was once unlikely became statistically implied. Step 2, liquidity was withdrawn across linked markets. Counterparties reduced exposure preemptively. Credit lines tightened. Collateral requirements increased outside the silver market itself. Step 3, margin pressure spread laterally. Positions unrelated to silver were liquidated to meet obligations tied to it. Funds sold what they could, not what they wanted. Step 4, institutional exposure surfaced across balance sheets. Insurers underwriting settlement risk, pension allocations using metal-linked funds, and cross-commodity vehicles sharing collateral all absorbed stress simultaneously. The analogy is a margin call echoing through connected rooms. The initial call is contained, the response is not. Once obligations intersect, isolation ends. At this stage, escalation no longer required new triggers. Margin hikes had already constrained behavior. Halts were unnecessary. Participation had already thinned. Rule changes were embedded into operating assumptions. What advanced now was contagion. Cross-default clauses activated review processes. One delayed obligation forced reassessment of unrelated contracts. Risk committees widened their scope from asset-specific to systemic. The historical rhymes were complete. In 1980, silver stress forced leverage players into failure beyond the metal itself. In 2008, defaults cascaded through instruments that shared collateral but not purpose. In 2022, the nickel halt exposed how concentrated exposure could destabilize clearing members far from the original trade. Default risk does not need declaration. It propagates through documentation. And documentation was now being read closely. Signals confirmed systemic spread. Dealer premiums became irrelevant for size. Large transactions simply did not clear. Delivery delays were replaced by refusals. Quiet, selective, definitive. Inventory reports lost informational value. Eligible versus registered distinctions no longer mattered once confidence in conversion disappeared. Industrial demand pressure transmitted into financing markets. Reported indications suggest suppliers demanded guarantees unrelated to price, focusing instead on counterparty strength. But beneath it, obligations were being repriced, not in dollars, but in trust. At this stage, the system stress was no longer about silver. It was about whether paper promises could still be treated as interchangeable. And once that question is asked seriously, the answer spreads faster than price ever could. What visibly broke was the assumption of closure. On the screen, markets continued. Prices stabilized into ranges. Volatility receded. Commentators described consolidation. To the public, the crisis appeared to have passed. Inside the system, positions never truly resolved. Outstanding claims remained open under revised terms. Cash settlements replaced delivery. Exceptions became precedents. What had been an emergency posture hardened into a new baseline. The public saw recovery. This was not a return to normal. It was the establishment of a different equilibrium, one defined not by price, but by constraint. The repricing followed an unavoidable chain. Step 1, arbitrage remained impaired. Without enforceable conversion between paper and physical, price discrepancies no longer invited correction. They persisted. Step 2, liquidity stayed selective. Trading continued where settlement risk was minimal. It disappeared where physical exposure could not be avoided. Liquidity did not return uniformly. It retreated to safety. Step 3, margin became structural, not cyclical. Higher collateral requirements remained in place, reflecting permanent uncertainty rather than temporary volatility. Participation narrowed. Step 4, institutional exposure was reclassified. Assets once treated as liquid were rebooked as contingent. Risk weightings changed. Balance sheets adjusted accordingly. The analogy is a bottleneck that becomes permanent infrastructure. Once traffic patterns adapt around it, the old road is never fully reopened. The system did not heal. It adapted by shrinking. The escalation ended not with collapse, but with acceptance. Margin hikes ceased, not because stress vanished, but because participation did. Halts were unnecessary. Activity had already thinned. Rule changes stopped evolving and began codifying. Force majeure clauses were no longer theoretical. They were referenced, modeled, priced. The historical pattern closed. After 1980, silver trading resumed under fundamentally altered leverage rules. After 2008, liquidity returned only with permanent regulatory scaffolding. After 2022, nickel markets reopened with participation reduced and trust impaired. Each case ended the same way. The system survived by becoming smaller, slower, and more conditional. This episode was no exception. The signals confirmed permanence. Dealer premiums normalized at higher floors, not spikes, floors. Delivery was available, but only under restrictive terms. Quantity, form, and counterparty mattered more than price. Inventory categories stabilized. Registered metal remained low. Eligible metal stayed inert. The distinction no longer signaled opportunity. It signaled boundary. Industrial users rewrote procurement models. Reported indications suggest long-term contracts. Vertical integration and redundancy replaced reliance on spot markets. The dock adjusted first. The screen followed later. And when the physical system sets the terms, markets do not debate them. They comply. The price on the screen continued to update, but it no longer governed outcomes. The physical system absorbed the shock by restricting access, not by restoring balance. Once settlement becomes conditional, the end state is not negotiated. It is absorbed.